Hello value investors, thank you for joining me. Today I want to talk about how you can value a SaaS business. It can be called software as a service or platform as a service could be another one. Cloud platform as a service could be another one. So if you're new to the channel, please subscribe now so you can get my next value installment. Also, check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you which stocks I own and why, with balanced arguments for the stocks I own. So let's get started. So the idea of a SaaS business model, or those other names I referred to at the introduction, is that revenue is pretty much locked in. In theory, there's a low churn rate amongst its customer base. So the customer comes in, it's locked in to, let's say, a 1 year or 3 year contract. The idea being that because it's all locked in, the company has a lot of predictability. And the idea being that the appeal of that product or service is so strong that once the company is done the onboarding, inertia or just the familiarity of that platform will keep the customer locked in for a long period of time. This is the idea. Okay, now companies growing at, let's say, just call it ballpark 30% annualized, okay? And let's say that this year the company has about 750 million in revenues annualized. So next year it could be close to $1 billion, okay? You look around and you say, okay, hypothetically, if the business can cut back on paying out so much in stock-based compensation, it could have 10% on operating margin. So we'll come back to our stock compensation in a second. But if you have 10% operating margins and the business is growing approximately 30%, so next year has $1 billion of revenue, that means next year, hypothetically, it could have 100 million in operating profits before interest, before taxes, okay? So if the business is saying, okay, the business is growing at 30%, and I can see the argument that the business should be valued at, let's say, 40 times operating earnings. Now, that is a punchy multiple. It's not crazy. It would equate thereabouts to a 4 times sales, which comes up to about 4 billion market cap. Okay, so that's fair. You could argue indeed that the company should be valued at, let's say, 5 billion because it's locked in and there's this and that and this and that, so the business is growing and it should be valued at 5 billion, so you're paying 50 times operating earnings before taxes and before interest. So on this working assumption, it hasn't got a lot of debt. It's kind of a clean business. So if you look around the SaaS world, there are a few SaaS businesses trading for 5 times sales, but the bulk are unprofitable since the inception, and the bulk of them are being traded at north of 10 times sales. What's more, many of these businesses don't really have their customer locked in for that period of time. Many of them are on monthly contracts. The idea being it's a cloud business and you can lock in customers over time. They get more familiar and it's easier to convince them. But many of them have all these caveats, so that's something to look at. You can just go through the 10K and you can just straight away see within the risk factors right at the top what's the contract structure like. So I've just brought up some ideas right away. So non-GAAP earnings, the main non-GAAP earnings is the stock-based compensation. That's essentially a business saying, okay, I'm not going to be priced at clean earnings, but I'm going to be priced at what it would be before costs. Because the bulk of the costs is really management compensation to retain talent. That's it. There's not other costs really, It's not that they have to get a large expense of land or etc. Most of the time it's just a small office. So the cost is really to keep the management team, whether it be the sales team or whether it be the developers. When you look at non-GAAP, you got to bear that in mind. Okay, they may leverage that out, that means that as the business's revenues grow, it should, in theory, the stock-based compensation should remain flat, so you get a lot of operating leverage. That means that the more the revenue grows up, the better the margins look over time. Now, this is all in theory, but it's very difficult at this moment in time to come up with hard evidence for this. So when you're looking at a business that is growing at, let's say, north of 10 times sales, it becomes quite tricky. So I don't have any position whatsoever in Cisco, but Cisco is classed as a old economy company. So it's pretty much a hardware company. It is trying to pivot over into something, let's say, like it is trying to grow into a bit like a software business with a bit of recurring customers. Approximately 30% of its total revenue is services, and within services, 30% are customers being locked in. But for all intents and purposes, it's a 70% product company selling you connectivity, and in connectivity in terms of connections to the network, where it has a lot of software going through that, but essentially it's a hardware company and it's valued as such. So it's valued at approximately 4 times sales. Now, I am fairly bullish that Cisco is cheap right now, because I think that it's a strong company, has high operating margins, it kind of has a strong balance sheet, not as strong as it was about 2 years ago, but it's relatively strong, and it has a dividend, approximately 4.3% yield at the moment, and it has up to now some repurchases as well. So it is a business that over time spits out strong free cash flow. Got a video that helps you figure out what free cash flow actually is, and it spits out free cash flow that it can use to repurchase its shares. Okay, so that's something that could work out. There's not a lot of jazz to that investment, but it could work out positively. On the other side, you got something else that is like Zscaler or Zoom or something like that, that is just priced on rhetoric. It's very difficult to find a business that is priced at north of 20 times sales, that is, you have any maneuverability there. It's very, very difficult. Let's take Zoom as an example. So Zoom is priced at approximately 90 times trailing sales, okay? Now, it could be the platform of the future, but at 90 times sales, it's kind of difficult to find what upside an investor has that hasn't already been priced in. I mean, there's no doubt there. There's no skepticism at all. 90 times sales, I mean, it's very difficult to find any upside that is already not priced in. So they're not the same business, obviously. You got Zoom that is very asset light, and you got something like Cisco that is totally different. But I'm just throwing out an idea. And I came to this because I was reading through Buffett's 1997 annual report and 1998, and he comes up with that idea, kind of a joke, saying that if I was to do an MBA course, I would give an MBA student only one question. What can you value an internet company at? And anyone who gave any answer was failed automatically. Now, a lot has changed in 20 years. Obviously, we've seen that how beneficial internet companies have become, and we can see that in our new work-from-home lifestyle, it's very, very rewarding to have this type of company. I can see that. But it's an idea that is just taken to excess. So there's a little bit of granularity there, a little bit that is true. Yes, okay, I can see that in the brave new world where these digital companies will be low touch, and I can see that, right? There's a lot of recurring revenue, large amount of visibility. But everything else on top of that, like how does this person price that? So what I wanted to say, anytime that you look at a company like this, just run a back of the envelope calculation. Think, okay, look at the best businesses. For example, something like Microsoft that I come back to often. Microsoft's operating margins are approximately 35%, thereabouts. That is one of the best businesses in the world. That is a business that it does have some avenues that it's trying to grow with Azure, but for the majority of the business, it's quite a mature business. It's not growing at anywhere near that level at 30%. It probably is growing in the ballpark of 15 to 20% on the revenue side, and with all the share buybacks, it can grow at 30% on the bottom line. But that is a business that is at its best. Very few businesses are the next Microsoft. Very, very few businesses. And so if you just say, okay, even if I want to look at a business that's half of Microsoft and you're looking at about 15% operating margins, that's the common sense what you should think about. When the business is reaching maturity, it can go to about 15% operating margins. And if you're pricing a business at 20 times sales, it doesn't leave a lot of upside. I mean, it's very, very difficult. There will be, from this day forward, some businesses that not only will continue to thrive in a new economy, and we will look back and say, wow, 20 times sales, that was really, really cheap. You can see this case with, let's say, totally different again, but you can look with Shopify and you can say, wow, when I saw that business being priced at 40 times sales, I thought, wow, that's expensive. And I look today, it's 50 times sales. And I'm going to look next year, that's 100 times sales. Now, it's very, very difficult, and there are going to be some winners. That doesn't necessarily mean that all these companies are going to be winners. It's very important when a person invests to be prudent. The most important rule is do not lose capital, because when you lose capital, it's very, very difficult to make the next investment work, just to come out break even. So, hope you found this video useful. Come over to my marketplace on Seeking Alpha, Deep Value Returns. Do a free trial, see if it works for you, and I hope to see you next time.